Hello and welcome to today's Trade in the Markets Live, where we're looking to capitalize on some opportunities as we approach the US trading session. So we're going to have an influx of capital coming into these markets. So just before we get into it, if you are genuinely interested in learning how to trade these financial markets, we can certainly help you as an organization. Just feel free to go. Currently up on the screen, you'll see our website there on the right hand side of the screen, the livetraderoom.com. We've got a range of really high quality products and services available for traders, from education to trading tools like our risk management software, and we've got 4 different educational courses, in-depth courses to suit different experience levels as well. And we have our daily mentorship programs and things like our signal service as well, so we notify you of the trades that we get in and out of. And the good thing is we can offer this for a very, very small price, for as little as $15 per month. So for more information, just go to our website. So without further ado, let's prepare for this session now, and we'll see what opportunities we have. So if we can just begin as always with our risk warning. Take a brief moment and familiarise yourself with our risk warning.
France is to add restrictions to the UK borders.
Okay, I'll just pause the live squawk there, and I'll put it back online in just a few seconds. Okay, so let's get straight into it then, and we will start with a review of market moving news. So it's really it's very useful from a sort of getting yourself into a routine of just being able to assess some of the news events as they occur. And you can see we've got crude oil inventories. Anyone trading the crude oil markets, just be mindful we've got the inventory number due out. We're expecting a negative figure. Minus figures are likely to support. It's likely to increase demand for crude oil because the inventories are less than expected, so there's often a demand for oil at that point, which is likely to push prices to the upside. So it's a bit counterintuitive. We're looking for a negative figure, and if it comes in line with expectation, then that very well may be priced in. If the inventory number is much less than what's expected in terms of a greater negative number, then that can we could often see a little bit of an impulsive move to the upside as a result. So what we have today, and we've had over the last few days, is central bankers talking to the markets, trying to ease these inflation fears and anxieties. And it's probably a good time to just bring in the 10-year Treasury notes, look at the bond price, and you can see we're kind of on this downward trajectory. Now, there's many that believe this level, which is currently at 1.55, will be up by 2.5 in the not too distant future. So we're expecting an impulsive wave to the upside. So the question is, what does that mean for us, this discussion? We've got these FOMC members speaking over the course of the day, and a lot of the conversation right now is all around inflation and the downside that inflation can have, and what it means for things like the stock markets, which is, if inflation ticks higher, then there's an expectation that the Fed are likely to firstly start to taper their incredible bond buying program, and then as a result probably bring forward the time frame for increasing interest rates. If interest rates increase, we've got a debt-burdened economy through government debt, corporate debt, household debt, are all at exponential levels. And if they increase the interest rates, then the cost of repaying those loans start to become a little bit more difficult, and therein lies a set of additional problems for an economy. That is likely, the US economy is in the early stages of a bit of a boom, so we've got this growth picture and view of these markets, and And if it's you may be familiar with some of the sentiment behind these markets. They're a little bit erratic in the sense that one day it'll be about fears about inflation, and you'll see stock markets selling off a little bit, and the next day it could be actually there's a lot of stimulus in play, a lot of growth, a lot of positivity. Slowly people are coming back to work and the economies are reopening and things like that. So there's a positive news story which is actually good for indices markets. And we're also monitoring the commodity markets as well. They're currently taking a little bit of a dip, but we'd expect further upside in some of the commodity markets as a result. So do keep an eye on that crude oil inventories number for anyone looking for an opportunity in crude oil at 3:30. But as you can see, there's nothing this afternoon that's likely to certainly impact our trading decision making for the time being. So that's just a little overview of the market moving news. So now let's see what opportunities we have for you today. So what we shall do is bring up last night's trade plan. So these are the markets that we were focusing on and discussing in quite some depth. And we do have this webinar every evening at 9 o'clock for about 30 minutes. It allows us to predetermine where we're looking to enter these markets. So it's a case of being prepared for the moves when they occur. And so we're looking for, if I just bring my pen, so we're looking for the euro dollar to the upside, the euro pound to the upside, the euro yen to the upside. There's a little bit of a focus at the moment on the euro, and you can see all of these three markets are currently pulling back. So we failed to break the highs on each of these markets, and just currently just rolling over. We're still in the euro dollar to the upside, and we're also in the euro yen sorry, excuse me. We got into the euro dollar yesterday and we took a small loss on a little bit of a erratic price action, but prices have failed to push on. We would expect, once you get a close above this level, you'd expect a little bit of an accelerated move to the upside, but as you can see, we've not seen the move just yet, put it that way. But we are still looking at this to the upside if we get a turnaround move, except prices are currently just rolling over to the downside. So actually the only market we're in at the moment is the euro yen. So let's see if we get further upside price action in this market. So the other two markets that we're looking at really is the dollar Swiss to the downside. So we're looking for some continuation trade to the downside. Currently we are, and again it's this looking at this break to the downside. But today we're getting a little bit of this reversal price action, as you can see. So we're certainly not looking at momentum in these markets at the moment. It's a little bit of reversal price action. And the other market is the gold trade. So yesterday we saw a little bit of a breakout of this pretty tight range, and now we're looking closely at this market to the upside for some further gains in the gold price. Just keeping a close eye really on markets like the S&P 500. What we have inside this little zone is a number of daily highs, a couple of daily lows. Even the 4-day high is within this little zone here. We have the monthly high sitting in at the 42.20 level, and this is your all-time high just above it. So we spoke about the potential of this level being a resistance level on many occasions. We've got a little bit of support in here, and what we're seeing right now is just a little bit of up and down in this fairly tight range as far as the S&P 500 is concerned. So really we're left with these markets. We're left with kind of a lot of reversals, and the one thing that we look for, we know what type of traders we are. We know that we're trend traders. We look to go with the flow of the market. So when we see these reversal signals, they don't fit with some of the trading opportunities that we look for. So we always look to go with the market rather than look to cherry pick the times where you get these little pullback trades. So in all of these euro trades, the euro dollar, the euro yen, the euro pound, we're still looking for further upside, but we need to go into the smaller levels to see if we start making a low and if we start to see price actions start to roll over. We call them structural failures to the upside. So that's really the plan for the euro trades. Currently they're selling off, so we'll let them sell off, let them find a floor, let them find a level, and then if we start seeing a bit of consolidation at those lows, then we might get little breakout trades to the upside. So just the fact that they're currently reversing now, it doesn't necessarily mean that we can discount them as potential opportunities. But clearly, patience is really at the fore with these markets today. You don't want to be jumping into a market that's selling off like the euro dollar, unless you're looking for a sell trade, of course. We are just looking for a buy trade in the euro. We're discounting this current selling. We're not interested in this little short-term move. We're looking for the kind of the swing trade to the upside. So a market that's really worth looking at now then is the gold. So we've had very little volatility for 5 days, as you can see, very much between the 1889 and the 1862 level. So about a $17 range for most of that trading period. And yesterday we saw the breakout above the 1899, and now we can look at the continuation above the daily high. So let's just take a bit of a deeper look into this. So this is your daily high here. It's just a fraction above. And so you get the breakout trade to the upside. So this is how we read these markets. We identify these levels. We saw the little breakout. Then prices come back to this level. So this is a level of resistance until prices break through, and then it becomes a level of support. So you would expect prices to roll lower below resistance and bounce to the upside off the support. So trade number one, if you are at your trading desk in the early hours of the morning, is your breakout trade. So BO for breakout trade. But this is your trade number two. Unfortunately, this is sort of pre-European Open, but this is trade number two. And this is your pullback trade. So we want to know which markets are we looking at, why are we looking to trade them, what type of trade are we looking to get into. So you've got a couple of opportunities here, and you've got to wait a bit of time in between those opportunities, of course. And you can see the general momentum in this market is to the upside. So the question is, how do we trade this price action here? Prices have ticked to the upside. We've made a new high. We've pulled back. So we're making these higher lows in these markets, which is the definition of an uptrend. But this high in here is the first time where we failed to make a new high. So this could be the beginning of a little bit of a reversal price action if prices break that sort of 1900 level. So on the daily time frame, it looks like a buy trade, but when you break it down, you go into the smaller time frames. Like I said, it's only if this market breaks through that 1900 level would we expect further softening in this market. And we're just in this little sort of transition phase at the moment, which just puts a bit of a question mark over the timing of a buy trade. That's really what we're talking about here. So that's the gold market. So what we can do is we can preempt what we would like to see happen, and what we would prefer to see happen is prices, fail to make this new low. If it breaks through this low, then it's a structural failure to the downside. And this is just how we kind of read these markets. And let's say we took price action, started to perform like this, and we can identify these highs and lows as resistance to the upside and support to the downside. then we can look to trade the breakout above that 1909 level. Or equally, if the price starts to break down to the downside, we can look to sell it below the 1900. So we are just in this little pocket of sideways moving price action. So it's a case of kind of waiting, being patient for the move. One of the things that we really focus on one of the things that we regard as one of the pillars for trading these markets, especially over the last year or so, is unfortunately patience. It's the timing of the trade, and sometimes we get the timing wrong. Sometimes that we have to get into a trade once or twice to be proved correct, but sometimes the analysis is fine. So, like for example, the euro dollars, the euro trades is a good example, because we would expect the euro to continue to strengthen. It's just currently pulling back right now, so we're not going to be sort of doubling down on the trade as prices push lower. That's a recipe for disaster over the longer term. But what we can do is we can wait for these markets to pull back. We can then identify a bit of a floor in these markets and then look to capitalize on prices pushing higher. So it's unfortunately a waiting game, and it's the same situation with gold. Our bias is to the upside. We know it's one of the better markets out there. I'll turn on our live squawk just in case we get any sort of further market updates. The gold market, it's that 1903. That's quite an important level. And then, unfortunately, if it breaks to the downside, then we can back off it just a little bit. So this is what we have. The euro dollar is just picking up a little bit of pace. What we'll do is we're just approaching the top of the hour. None of these markets are moving in the direction which we want them to. In fact, we're getting this up and down price action quite a lot over the last week or two. So it does make it slightly frustrating environment to capitalize on a high probability trade. And just flicking through all of these markets, then we'll do a little bit of, so we can see that there's some dollar strength creeping into these markets. Nothing really going on in the pound dollar just yet. Same situation with the dollar yen. We've got 6 days now of just this market doing nothing. A little bit of short-term buying creeping into the dollar Swiss. So again, very, very mild dollar strength. And yesterday we failed to break through this level to the downside, the 2072. We got close to it, and now there's an opportunity for a little bit of a small pullback. But what you don't want to forget is that the direction in this market is to the downside. So that's the trend, that's the direction, that's the momentum, that's where the momentum lies. You can see just even more recently, you can see where all the volume in this market lies. They're all to the downside. So as a result, we would be looking for selling opportunities in the dollar CAD. It's just currently pulling back. So here's a structural failure to the downside already for the Aussie dollar. So this is when the market creates a low, fails to make a new high, and then we get that flush to the downside. So it allows us to, here's the opposite to the upside. So we are trading a market that's creating structural failures to the upside, and now also structural failures to the downside. So again, if you do your analysis and you can technically look at markets like this, you're left with a bit of a question mark. And often we use the phrase, if in doubt, stay out. And that's unfortunately what we're dealing with some of these markets right now. And if you look at this on a daily time frame, we have this market just range bound, broadly speaking, within this range. So it's just going up and down, as you can see. Little bit of a potential breakout, which kind of reversed pretty quickly. So we had this little reversal signal kick in. But we are trading between 77, let's say the 78% level, and roughly the 77. Yeah, 77.12. Yeah, so we're talking about 100 pips range in a market like the Aussie dollar, which is very, very small. What I'll do is I'll just show you the volatility of this market so you can see it for yourselves. Where are we? Sorry, it's an average true range that I'm looking for. So let's put this in down here. So you can see that the range is really down at these lows. We're talking about 68 pips in a day's trading. And this is where sort of profitable risk reward comes in. So if we took a trade with a 40 pip stop loss, you'd have to wait a couple of days before you'd see, at least 2 times your risk in a trade like this, because you're only going to get on average 68 pips in a day. So trying to get in and out in that one day is going to be really quite challenging and potentially a little bit unrealistic. So this is where you want to take these things into account. You want to see the potential for that return. And again, sometimes we get a really good trading opportunity, but the potential for the return is not there. So we're either going to run into support and resistance, or the range of a day's trading doesn't allow for the trade to develop. So I hope that makes sense. If not, do feel free to post any questions you have into the chat box. But we're seeing these markets which are, and I can zoom out even further on this. This is the reality of the Aussie dollar, and again, it's just that range, that 150 pip range that we're talking about, and that's been pretty much the price action in this market since December. So as a result, we can't get too active in the Aussie dollar just yet, because it's not giving us the opportunity to do so. Really, we're assessing the market conditions, and they're not great. Now, the New Zealand dollars is a little bit of the outlier out of all these markets, as you can see. This is where we've seen the volatility, largely as a result of last night's monetary policy statement. So they've kept rates at 0.25. We had the RBNZ press conference and rate statement, and the net result of that event meant that this price rocketed to the upside. And you can see that this is obviously during the Asian session, so it's this market was in a pretty tight range for most of yesterday. And then in the early hours of the morning, you get this market rocketing to the upside. Now this is a 15-minute candlestick, so within 1, 2, 3, 4, 5, 6, 7, 8. So within a 2-hour period, it's pretty much gone from the 72.32 up to the highs up here in and around the 73.10 level. So you're talking about an 80 pip move in a 2-hour period, which is fine, but it's done nothing since. So when we enter the market, I don't know, around here, perhaps sometime around here, you can see that this market fails to make new highs, and it's actually looking like it's potentially going to roll over to the downside again. So this is when sometimes we look for a buying opportunity, and really the buy now is actually above the high. So that's when we get a breakout of this sideways moving price action. So if we break to the upside, there's your buy trade. It's above the monthly high, it's above the daily high, and we've got a nice neat stop loss here to place your stop loss. There's your entry, and it can be that straightforward, and we're going in line with the recent price action to the upside. So that's how we would sort of look to trade that. But then we look across the dollar against all the other markets, and the dollar's actually strengthening, or mildly strengthening, let's say. The exception is the pound dollar. So what we have in our hierarchy of strength and weakness, and that's really what trading foreign exchange is all about. It's trading the strong currencies against the weaker currencies. We actually have a situation where, like markets like so if we have strength versus weakness, weakness. So if we do our analysis, what we find is we have the New Zealand dollar is one of the stronger currencies. Then we have the pound, which is sort of mildly strong, and then we have sort of weak markets like the euro. Not too sure about the yen. The Aussie is I think mildly strong. The CAD I think is weak against the dollar, yeah, the Swiss franc as well. So straight away you can look for opportunities in the I haven't looked at the New Zealand dollar, I haven't looked at the New Zealand CAD or the New Zealand Swiss, but those are likely to give you fairly decent opportunities against the euro. Right now it's just finding a little bit of a weakness, so we might get a decent trade there. What I might do is just have a quick look at the if I take this off the screen for a second and we look at the Euro New Zealand, we'll see if this market is pushing to the downside. Euro New Zealand, let's have a quick look at this trade here. We'll have a look at the daily time frame. We'll do a little bit of analysis. So there's your move to the downside. So that's just off the back of kind of support and resistance. So actually there might be another opportunity below this level here if prices, they've clearly failed to make new highs, and then you get this little flush trade to the downside. Certainly believe this little level in here is kind of your high probability trade. Let's see the overall direction of this market's to the downside. So it starts to fit in with the overall view. So price is pushing lower, and there's your consolidation. And if this market continues to the downside below this level, then there's a high probability trade in this market as well. So I suppose that's the basic bones of trading currencies, and we can see that the euro is weakening across the board because of that New Zealand pound and marginally yen strength. The yen is kind of in the middle really between the two, so not great opportunities today for those trading the majors. Looking at the commodity prices, you can see what's happening. So we want the gold market to kick on to the upside. Plenty more upside in this market. If we look at the weekly time frame, for example, we've been in this nice little breakout trade, this little uptrend in the gold market, and this market can easily push up to sort of new highs at the 20,000 level. So there's still further upside potential in this trade. We just want it to break out of this little sideways moving pattern, and like I said, you got easily defined stop loss with an entry above the high. So
sent out
this is our resistance.
Money email, a few tidbits on infrastructure, nothing we haven't really heard already in the last 24 hours or so.
So
they say why the infrastructure talks aren't in real trouble. Person familiar with the White House thinking tells Morning Money it is that while Republicans want to reprogram already allocated funds under the American Rescue Plan or previous stimulus bills, the administration doesn't think that's really possible or advisable.
Okay, I'll just turn that off there for a second. So you can see how we can kind of prepare for those opportunities. We just got to be careful in this little zone here, because right now this market could push higher, could push lower. We don't have any sort of edge really in this trade just yet. The move is to the upside, so that's why we're looking for a buying opportunity. Yeah, hiya LEJ. Do we have a set number of pairs, commodities that you follow, or do you check through loads every day? Really, really good question. We have a set number. We look at all the major pairs. So we look at all of these currencies against the US dollar. And what that allows us to do, LEJ, is work out which currencies are stronger against the dollar. So we can clearly see that the strongest currency today is the New Zealand, and we can see that one of the weaker currencies against the dollar is the euro. So we can use the dollar as a common denominator to see where the strength and where the weakness is. Does that make sense? But yeah, to answer your question, we look at the 7 majors: euro dollar, pound dollar, dollar yen, dollar Swiss, and then the commodity currencies, the CAD, the Aussie, and the New Zealand. So we look at these fixed, so we're just acutely aware of what goes on in the G7 effectively. And then the euro pound, just because we've got, we're UK European, we're obviously based in Ireland, or certainly I am. So we've got that interest in the euro pound. So we've always kind of tracked that and monitored the euro pound, especially with Brexit, and gave us some phenomenal moves in 2016, and so that euro pound we've always monitored. And then we just compare and contrast with the yen pairs. So to just take you back a good few years, the BOJ have been on a spending spree to inject a little bit of inflation into their economy. They've been stagnant now for over 30 years. So they keep quantitative easing, they keep printing. Sorry, I don't know what's happened to our... So as a result, if you look at something like this, the BOJ have been pretty much desperate to try and devalue its currency to varying different to varying extents. So in the build up to the financial crisis, there was this flight to safety trade. This 2007, 2008. A lot of capital was just flooding into the yen. And then they started their bond buying and their quantitative easing programs. I think it was around 2010, I might be wrong on that. But so the BOJ have just been printing, and there's been this sort of easing on their currency. So they've been desperately trying to devalue, and for a good few years there was this race to the bottom for all of your major central banks. And you have your little hiccups along the way as well. But the BOJ are still desperate to try and devalue their currency. But we've had this environment where stock markets have been pushing higher. So we've seen the capital flood into to your equity markets over the last period of the last 7 years. So it's quite a complicated relationship between the dollar and the yen. But it's always been a useful market to determine that flight to safety trade. So if capital comes out of indice markets, it generally goes into the yen. That's the traditional correlation, and the gold markets. But the gold market has some other issues with it as well, in terms of its hedge against inflation. So, but to answer your question, yes, we've got the 7 majors. We've got the euro pound, euro yen, and pound yen, and then we look at two commodity markets like gold and oil. They're the most traded commodities out there. and we generally get some good opportunities. Crude oil, I mean, it's been on a fascinating little ride for quite some time. We were down to the low teens there at one point last year as a result of the COVID situation. So there's always opportunities in crude oil. The gold market, it's a hedge against inflation. So we've got this inflation fears and concerns and stuff. So it's adding a bit of impetus to the gold market. So we're likely to see this market push higher as well. So we add in, and just to clarify, we look at multi-asset class. So we look at foreign exchange, commodities, and also global indices. And what that allows us to do is to identify where the correlations are and see where the flow of capital is going. So money's been plowing into equities for 12 years now. This is what it looks like. It's that constant, making of new highs, very much artificially driven to the upside as a result of central bank monetary policy, reducing rates, quantitative easing. It's just driving up asset prices. This is really where most people's money is ending up, until they start to pull their cash from these markets. And some of these little moves are very much return to cash type moves. So we're not really seeing the sell-off. We're not seeing it play out in other markets like we normally would do. So you can imagine that financial sort of textbooks, really, the economic textbooks, are kind of thrown out the window to a certain degree, because we've never been through this little cycle of printing and monetary policy and fiscal measures as well, all added to the mix. So we're in new territory as far as these markets are concerned, and sometimes they react with a bit of fear and anxiety. But then the realization, or the Fed tried to come in and sort of calm tensions and just say, no, everything's under control, and then prices start pushing higher again. So what's going to provide opportunities over the next year or two is the unwinding of the policy over the last 12 years. That's what's going to provide the next major round of massive moves. And how they do it and when they do it, that's what's currently being discussed across these markets as we speak. So equity markets push higher. We're in a state of risk-on market conditions, which means investors and traders are happy to take on the risk to get into these trades. And to just conclude, LEJ, from your question, we also look at the global indice markets. So we look at the US markets, we look at the couple of European, like the FTSE and the DAX, and then we look at an Asian market as well. So we've got that ability to diversify. We can see where the capital is flowing, and we can just focus on. The other thing about these markets that we trade is they're the most liquid and volatile markets in the world. So you'll always be able to get in and out of these trades because they're liquid. Plus we trade CFDs as well. So we don't have some issues that traders that trade other markets can have. And we're talking about liquidity now. So we don't have those issues, which is kind of one less thing to concern yourself with. And obviously, the more liquid and the more volatile these markets are, the more opportunities you get. It's just a case of sort of cherry picking the opportunity for what it is and being able to see it clearly. But does that answer your question, LEJ? So we look at 10 currencies, 2 commodities, and probably 5 other markets, and we just keep a little eye on Bitcoin as well. It looks like it's created a little bit of a floor in these markets, as you can see. Interesting to see just a higher low. So markets flush to the downside, we have a really strong bounce. Then we see the next leg to the downside, and we see a little bit of support kicking in. So now we'll be looking carefully at see if this market can break above the $42,000 level, basically. But this market will have a big decision to make in and around this type of zone here. So it's got two choices. Like, we'll either get that impulsive move to the upside, and then it's got a decision to make. So will it kick on to the upside, or will it actually reverse and put further downside pressure on this trade? And as yet, we don't really know. We're just a little bouncing off the lows. So just be mindful of that if you can. So LEJ, yeah, thanks Tim. Yes, it does. Good stuff. Yeah, and look, the biggest thing actually, LEJ, is there's so many markets to look at, and even sometimes, you know, even the 15 markets that we focus on and we fine tune every evening, as you know, we fine tune the opportunities. So 2, 4, 5. So last night's webinar, we had 5 markets to look at in today's market, in today's trading conditions. So we have this narrowing effect of our focus. Otherwise, we're flipping in and out of too many charts, and it's very confusing. And these are the charts that we look at, that we're currently looking at the moment. So we have this ability to just sieve through the opportunities. Sometimes we get all the runners in the markets we look for. Other times, not so much. Like today, it's not a great quality trading day. If I just get these trades back on track, was the S&P, gold, and then the last one is the dollar Swiss. So these are the markets that we're looking at in today's trading, and like I alluded to earlier, they're currently reversing in the direction in which we want to trade them. The only one that's sort of kicking on above that 1900 level is the gold market. I do apologize. There's something wrong with our camera. It seems to be tripping in and out. James M, do you often trade the crypto markets? What myself and a couple of people here who work at the live trade room, what we've done is got involved in cryptocurrency on an investment basis. So we've looked to take a small percentage of our funds and just look to. It's more of a gamble, really. It's more of a bet to the upside, you know, we look to add to cryptocurrencies like Bitcoin and Ethereum when we get big dips like these current situations now. So it does present a buying opportunity from an investment perspective. But just to be clear, James, we don't trade Bitcoin. It's just far too volatile. But we do look to invest in it. It's just really getting in, looking to hold it, and you know, we'll see if it pays nicely over the next year or two. It's got the potential to do it, but it's so volatile. We could be back at $10,000 in a few weeks. So we've seen prices drop from 65,000 down to 30,000 in a couple of weeks. So that's the level of volatility. It's been insane, really, to be fair. Yeah, you love the beard. Okay. I wonder which James M this is with us. Yeah, this is this beard of mine is it's a lockdown beard, really, I guess, as a result of COVID. Yeah, listen, my pleasure, James. No problem. Yeah, you wouldn't recommend trading CFDs? Absolutely not. I wouldn't recommend trading with leverage at all with cryptocurrencies. We have seen so many people get unbelievably smashed to pieces trading this. You know, getting offside, and there's people trading it without stop losses and everything. It's just, I don't know how people can stomach that type of sort of anxiety. It's if you're offside and you've exposed your whole account to this trade and it just drops like a stone, like in one day. Look at the range on this one day. So it opened. So we saw a high in this one trading day of 43,517, and we saw a low of 29,701. Now, if you're trading this market with leverage, you've burnt your account. Like it's gone. In one trading day, and for some reason, people keep opening up accounts and putting more money in and just continuing to gamble. You might as well go to the casino and just play roulette and just put it all on black or red. At least what you can do in a situation like that is define your loss. You can put 100 quid down and look to double or on one spin. But putting capital into a trading account and looking to buy at these highs, 43,000. And the problem with cryptocurrency traders is that they're so sure, and there's no way they can be sure. It's not like many other markets, other financial markets, which they move for specific reasons. There's fundamentals which ultimately drive price to the upside and to the downside, and they take a whole range of factors into account. But cryptocurrencies is purely speculative. It's like just extreme gambling. And I haven't come across that many people that have made that much money out of it, but a good friend of mine has been in it since 2017, I think, and he's still holding those. He does anticipate to get out around 100,000 if prices get up to that level, and he will have made an exceptional amount of money. So that's really the time when people should have got in. And the collapse as well, it was the December 2018, the massive collapse as well that we saw. Prices bounced off the 20,000 figure. We had institutional money coming into Bitcoin, and it collapsed, I think, down to about 3,000. So that was a bit of a painful period as well for him. He was always in money, actually. He was always in a bit of profit, actually. So but what he saw was his P&L go from exponential to just okay. So but look, his approach, as we've been consistently saying to traders for a while now, if you get into Bitcoin, get in on a dip and look to get in and hold it without leverage. You don't want to be leveraging up in a market like this, and that's just our opinion. So listen, that's fine, James. So LEJ, so long term, you are a big ADA fan and agree you can't day trade crypto markets. I mean, we see loads of people online and stuff day trading cryptos, and don't know how they do it. It's pretty mad. James, check out VET. Yeah, LEJ, it's the real deal. Interesting. So VET is a V chain by the looks of it then. Yeah, listen, my pleasure, Ellie J. Thanks for joining us anyway. And to be fair, guys, we're going to pack up now in just a couple of seconds. Unfortunately, we have a lot of these markets that are just really moving in the opposite direction to the direction in which we want to trade them. So we're seeing the euro dollar, the dollar Swiss, all reversing. So gold is probably given the best opportunity across these markets, as you can see. The euro yen just rolling off the highs. So they're all in reversal periods. We're looking at the S&P, and there's a lack of volatility in this as well. So yeah, listen, my pleasure, guys. Thanks very much for joining us. We're going to wrap it up there. The only market really to look at, and we said if we saw a break above this level, we're getting that break and that continuation trade. So there's a viable buying opportunity here. So look, I'll leave you guys with that, and we'll have a look at it now when we finish this broadcast. We've got another trading room to go to, trading session. So I'll leave you with these markets. And we'll be back again tomorrow at 12:30. So if you can join us, hopefully we'll have slightly better market conditions to work with. So from everyone here at the Live Trade Room, thanks so much. Take care, and we'll speak to you soon. Bye for now.